Hey guys, so today I'd like us to talk about risk, okay? Weighing risk and return. So first of all, we'll go over systemic and non-systemic risks. So non-systemic risks, okay, it's a risk that is particular to a said or specific company, and it doesn't affect other companies or the market in general. So investors can protect themselves against this non-systemic risk with proper diversification. And non-systemic risks contrast with systemic risks, because systemic risks is a risk that applies to all companies in a market or a sector or like some kind of industry. Non-systemic risk, they typically don't have any upside. It's kind of like a lose-lose type of scenario. Well, let's say, you invest in a company that's, is almost coming up with this new competitive edge, and the head of the R&D team who is the brain of the operation dies in a mountain climbing expedition. Well, that is non-systemic risk. It's like nothing you have control over. It's very specific to that company, and it really only has like downsides to it. And the only way to protect yourself against these non-systemic risks is diversification. If you didn't have only that company, but instead you were invested into the industry as a whole, well, maybe some competitor would be, reaping the benefit of that non-systemic risk and the unfortunate event that happened to that other company. But when diversification will shield you quite nicely against non-systemic risk, it doesn't necessarily shield you against systemic risk. So what is a systemic risk? Well, it could be, a big market downturn. It could be interest rates, going up or down. It could be inflation increase, politic risks, but it could also be like, a natural disaster. Let's say, Fukushima in Japan, that is a systemic risk, because then the economy of Japan in general was affected. So now I want to dive deeper into all these different investment risks. So we'll think about all the ways that you could basically lose money. So the first one I want to go over is financial risk. So this is the pretty known type of risk where basically if you invest money, you run the risk that you will lose some of that investment, some of that money. And this type of risk typically can be greatly reduced with the right amount of research and diversification. And a lot of those risks, is due to volatility. That's what keeps people up at night. But, risk, like that type of risk, shouldn't be avoided. It should just be mitigated, understood, and taken advantage of in some cases. Because risk and return really go hand in hand. Just like Corona and Lyme, risk, you can't have any returns if you don't take any risks. Then you have the market value risk. This risk is, it's typically the fact that the stock market can go up and down. And a lot of people focus solely on the market being able to go down, because they get scared of that hypothetical and for sure, a very certain downturn, let's say over 20% for 1 year. Because they're scared of that, well, they will miss out on the potential 40% increase over the following 4 years. I still want us to be acknowledging the fact that this risk is real. Like that's a real risk. If we go over the several downturns that the stock market has known, and I'll list them here, you can see that. For example, between 1929 and 1932, the market went down 89%, That's, that risk is real. And if you are scared of that and you pull out your money because it's too much for you, you can't handle it, then you're going to lose a lot of money in the stock market. Instead, what you should do is see those declines not as like actual like risk and a total loss, but instead as an opportunity. Because let's say, in 1929 to 1932, downturn, goes down 89%. But if you have some cash around and you reinvested into that sale, after the fact, a few years later, you would be way off thanks to that. But the human psychology is kind of playing against us. That's why, you need to have the guts to fight back this human instinct. Okay, because like thousands and thousands of years ago, if you saw some people running in one direction, you either thought that maybe there was a saber-toothed tiger that was going to eat you guys, or maybe someone, like a robber was arriving with a big axe and was going to rob you, so you would just run the other way. That's just the way we have been programmed. And the same happens on the stock market. You see people selling out, oh my god, downturn, everything's crashing, you sell. Well, yeah, but now you sold at a loss. And if you don't buy back at the right time, and you only buy back when the price went back up, that's when, you lost money when you sold, and then you lose money when you buy again. So instead, like if you identify a good company whose financials are strong, the fundamental makes sense, economy-wise, political-wise, everything makes sense. Everyone gets scared and starts selling. That is a good time for you to actually be buying. And once again, similarly to protect you against non-systemic risk, to protect you against market risk, you want again to diversify, because with a downturn, one specific market or sector might be down, meanwhile the other one are actually booming. Also, something that's very important in order to protect you against market risk is the time frame where you want to invest. So money that you put in the stock market shouldn't be invested for less than 5 years, ideally 10 years or more. That's how you're going to protect yourself against these downturns that I showed you earlier, while reaping the benefit over the long term for all these increase in economy and increase in overall market health. And something to make you feel a bit better over this market risk, if you look at the S&P 500 over any period of 20 years in history, it has never seen a decrease in value, even after being adjusted to inflation. So it's actually a pretty safe type of investment, as long as you consider, like 20-year time period. Then there's, of course, like the individual investment risk. So kind of what we said with non-systemic risk earlier, there's added risk if you invest in single companies, simply because there's so many factors that can play against that specific company. So you want to hold different securities, within the same industry and across several industries that you identify to be the most healthy industries for the future. Then a pretty infamous risk is the risk of inflation, Because if you keep all your money, let's say, in a savings account, money markets account, or low interest paying bonds, you run the risk that, over the years, the interest payments on those investments are not going to balance out the inflation rate. Then there's the career risk, So your career, because you never know what might happen. That's why you want to keep investing into your education, and you want to keep an eye on where is the market going in terms of job opportunities, because a lot of jobs that exist today, are going to disappear 20, 50 years from now. So there's all these new opportunities, job opportunities that create themselves as the world is changing, and you want to keep an eye and stay on top of this, because there might be something that interests you, that has more potential than what you are currently doing. So that's why career risk, very important. Want to stay on top of your training, of your education, so you don't lose your competitive edge. And then there's also the interest rate risk. That is true, like if you are holding like bonds, but also if you have like some money into savings account, money market account, anything that pays interest rate could go up, which might be a good thing if you have like high interest savings account, money markets account, but it actually is a bad thing if you just bought some bonds last week. And similarly, it could go down, which then would be potentially good if you had bought a bond last week, but wouldn't be as nice if you have some savings account. And then the last type of risk that I'll talk about today is political and government risk. Because for some companies, like a new regulation or a new law could mean bankruptcy for them. So politicians and governments have a huge potential impact on the stock market. And so as an investor, we need to ask ourselves, how is this new politician coming into power, or like this new law, this new regulation going to affect the stock market, and more specifically the stocks that I'm interested in? And also something to keep in mind is that especially in international type of investment and especially in emerging markets, again, politics and government can have a huge influence. If you have an investment, let's say in South Korea, well, the stock involve not only the normal business risks, okay, whether the business you invested in is going to do well or not so well, it also has the currency risk. And that currency risk, could be that the currency plummets in value, which means that your stock value will also plummet along with it. And along with that, there's also the geopolitical type of risks. Because if a fight was to break out between, two neighboring countries, the economy within these two countries might shift drastically, and that could have a pretty drastic influence on the stock of your company if you invested into these markets, like these countries. And so after talking about all those risks, I want us to touch base a bit on how to minimize your risk. Well, first of all, you need to gain knowledge. Because the more information that you gather about the stock market, how it works, how it gets influenced, okay, how to analyze companies and etc., the more tools you will have to understand at least a bit better how to navigate this stormy sea that is the stock market. And one advice I would have for you guys is to try yourself. There's actually some apps on your phone that you can download that simulate the stock market, where you can actually invest fake money. You can get like $30,000 worth of portfolio. You invest it, do the homework, select the companies, invest them, and wait 6 months, see how it does, And over time, you can transition, and instead of going 100% into index fund, you can try and start, invest 1% of your portfolio into individual companies. And the more confidence you are getting, the more success that you see you are getting doing so, then you can add it to 2%, 5%. Then you also want to have your financial in order. Before you start worrying about the financials of other companies, you should first worry about your own financials. So for example, you want to have some emergency fund, okay, some, a soft pillow of money to land on in case of a storm hits the fan. And thinking about, your own financial also includes wanting to reduce, if not eliminate, all of your debt. That's in a priority before actually starting to worry about the stock market and the financial of some companies. And finally, you want to diversify, okay? This word comes over and over again, but that's very important. And one easy way to diversify, honestly, is just to invest in some ETFs, okay? Either like into a broad market ETF or an all-in-one type of ETF. So that's all I have for you guys today regarding risks, so both investment and overall market risks. I hope it was interesting. I hope you liked it. If you did, please subscribe, leave a like and a comment down below, and I'll see you in the next one. Have a good one.